Students of economic history and certainly competent investors know that the international monetary system has collapsed no less than 3 times in the past 100 years: 1914, 1939, and 1971. But according to my guest today, the next collapse could be far more severe than those experienced previously and could very well precipitate the end of the dollar's reign as the world reserve currency. He's Jim Rickards, the author of a new book called The Death of Money: The Coming Collapse of the International Monetary System. Now a New York Times bestseller, and deservedly so. My audience knows, Jim, I'm not one to shower praise on too many of the books that I read, but this is a rare exception. Jim, thanks so much for making time to appear today on our program.
Thank you, Brian. Glad to be with you.
You know, Jim, I'm currently reading the book, and the thing that struck me right off the bat within the first few pages, and I'm sure it was intentional, but it's one of the reasons I'm enthusiastic about this book, is that the text does not read as though it was written for what I would call the academic eggheads. It's a very straightforward and really is written for the common everyday investor.
Well, that's right. Thank you for picking up on that. That's very much by design. Actually, going back to late 2010, when I first met with my publisher before my first book. My first book was Currency Wars. That came out in 2011. The new book just out is called The Death of Money. But before either book came out, I said, I have no interest in writing for the academic audience. I've been very involved with academics. I've shared offices with Nobel Prize winners. I've been in committees with 16 finance PhDs, so I'm familiar with that world. But they really only write for each other. It's a very small audience. It's amazing how many top-name economists don't even write books. They write academic articles for publication in journals. Some of them write books, but not that many.
Yeah.
I said, I want to write a book that everyone can read. Now, having said that, it doesn't mean that it's dumbed down at all. The content is actually very high level, but the style is plain English, use metaphors. I'll give you an example. Economists will talk about downward nominal wage rigidity. Well, what the heck's that? Well, it's a fancy way of saying people don't like to take a pay cut. Well, if I tell you that people don't like to take a pay cut, everyone understands that. You can say it in plain English and skip the jargon. So I do that. So I think we're trying to present high-level concepts in plain English that everyone can understand, and it's important. Because I like to say, when it comes to your own money, everybody has a PhD.
That is so true, Jim. And I also congratulate you on really crafting a text that I think there is something there for every single investor, because obviously you have those that are a little more experienced. They're on the far end. They're in their 60s. They're in their 70s. They may have a much larger nest egg to protect. But you also have folks that are in their 20s and their 30s. Certainly, if they've watched their parents get their 401ks wiped out and they've seen how they have struggled and had to altered their retirement plans, now they're thinking about the future. And the book really does, I think, present something that everyone can really value. And it's really informative. So I congratulate you on that. It was an effort that really paid off. Thank you. And there's even a section in, I believe it's in chapter 7, where we talk about student loans and the impact student loans are having. I think that's a pretty well-known subject, or maybe not. There are over $1 trillion of student loans outstanding. That's about the same amount of subprime mortgages and similar so-called alternative A mortgages in 2007, just before the mortgage market collapsed. It's an enormous burden, but I talk about how the Treasury is actually using this as a backdoor stimulus program, because you give money to college students, they're going to spend it. That's what the Treasury wants. They want the spending going on, the borrowing and the spending. They don't want people saving and investing. College kids are going to write checks to the schools. The schools are controlled by unions. You got union faculty, union administration, and so forth. So it's really just kind of a scam where the kids get out of school. They might have a nice degree, but they've got $200,000 in debt, no job. They're living in their parents' attics, and they say, "What happened?" And so the book speaks to that age group, as well as the 70-year-olds with a lot more net worth to protect. Well, I'm glad that you addressed that issue too, because we really are talking about, for younger people, I mean, they will be financially enslaved by that debt, won't they? That's right. And student loan debt, you may know, there are only two kinds of debt that you cannot get rid of in bankruptcy. Like, the whole idea of bankruptcy, and this has always been an important part of the U.S. law, is that all right, we understand people make mistakes, things don't work out as planned, people get in over their heads. Rather than sort of be debt slaves, the United States has always had provision to say you can work it out with your creditors, file for bankruptcy, get a clean slate, and start over. It's not fun, but it's doable. But there are two kinds of debts that you cannot get rid of in bankruptcy. One is taxes. Well, that makes sense. Nobody wants to make it easy to get out of taxes. But the other one is student loans. So if you have credit cards, mortgage debt, car loans, whatever, a lot of that stuff can go away in a bankruptcy proceeding.
but student loans cannot. So you're stuck with it. They'll garnish your wages, withhold your tax refunds. You get a bad credit rating. Then, with a bad credit rating, you can't get a job because employers these days are doing more background checks and using credit ratings. They say, well, if you have a bad credit rating, maybe you'll steal, so I won't give you a job. You can't get an apartment. I mean, the deleterious effects, taking our best and our brightest young people and running them off the rails from a credit and job perspective because they took on too much debt because the tuitions were too high and the whole thing was a government scam. This is a disgrace.
Absolutely. Jim, let's talk a little bit about the title of this book, The Death of Money. At first glance, I caution my audience because you might mistakenly interpret that as being intentionally very provocative. But in fact, what I find really refreshing, and I truly believe underscores your credibility, Jim, is the fact that, unlike the majority of experts on this topic, you don't present the facts and the very real prospect of a dollar collapse as this ultimate doomsday scenario, but you absolutely acknowledge that it will prompt the world's major powers to redefine what you refer to as the rules of the game. I'm curious, Jim, if you can explain for the audience, what are the rules of the game as they're currently defined?
Well, the rules of the game, that phrase, by the way, goes back 100 years. It's not my phrase. I use it in the book, but it's really what the elites, when I say the elites, I mean, finance ministers, treasury secretaries, central bankers, private bankers, academics, the elite group that run the international monetary system. When they say the rules of the game, they mean the rules and processes by which the international monetary system is conducted. And they change from time to time. Now, currently, we're on, you could call it a dollar standard. Prior to 1914, we were on a classical gold standard, where if you were a country and you traded with another country and you ran a deficit, you had to settle up in gold. You had to actually pay them physical gold. Sometimes it was shipped across the ocean. Sometimes it was kept in a vault, and they just changed the name tag. But your gold became the other guy's gold if you ran a deficit. But this was a good discipline on how you ran your economy and how you tried to prosper and create real wealth as opposed to phony wealth through derivatives and things we have today. That fell apart in 1914 with the beginning of World War I. So after World War I, in 1922, they rewrote the rules of the game. They came up with something, they called it the gold exchange standard. It didn't work nearly as well as the classical gold standard. It had certain dysfunctions. The problems really didn't relate to gold. It related to the price of gold and discretionary monetary policy. But that system fell apart in 1939. Then beginning in 1944, the new rules of the game were the Bretton Woods system, and that was one where all the currencies in the world were all the big ones were anchored to the dollar, but the dollar was anchored to gold at $35 an ounce. So indirectly, the other countries were on a gold standard too, because they linked to the dollar and the dollar linked to gold. But of course, that fell apart in 1971 when Nixon went off the gold standard. Basically said that these countries, if you earned dollars trading with the United States, you could use your dollars to buy stocks, bonds, and real estate, but you couldn't get the gold. So then the 70s were a period of turmoil. We had 3 recessions, a crashing stock market in 1974. The price of oil quadrupled. The economy fell apart from 1977 to 1981. In that 5-year stretch, we had 50% inflation just in those 5 years, 50. The value of your dollar was cut in half in a very short period of time. Now, why didn't the dollar collapse in the late 70s? And it came very close to doing so, and I talked about that in the book. The answer is 2 words, Volcker, Reagan. Paul Volcker raised interest rates almost to 20% to make the dollar a magnet. He said, we're going to make the dollar valuable again. We're going to pay you. If you invest in the U.S., you're going to get something for your money. We're going to raise interest rates to 20%. Reagan cut taxes, cut regulation, and unleashed a period of very strong economic growth in the mid-'80s. That combination saved the dollar. And then from 1980 to 2010, that 30-year period, we were on a dollar standard, not a gold standard, but a dollar standard. And what the U.S. said to the world was, hey, we, the United States, will maintain the value of the dollar, and you, our trading partners, can link to the dollar any way you like, but you can count on us to maintain a stable store of value. That worked extremely well, by the way, in Democratic and Republican administrations. It was Reagan, Bush Sr., but also Bill Clinton, Bob Rubin, his Treasury Secretary. They stayed with this so-called King Dollar standard. In 2010, the United States tore it up, abandoned King Dollar, said we want a weaker dollar, and since then we've been back in this period of turmoil and uncertainty. So what I'm explaining to the reader is why the next collapse is coming. The last one was 40 years ago. These things do happen every 30 or 40 years. It doesn't mean it happens like clockwork tomorrow, but sooner than later, yes. And then what will replace it? What will the new rules of the game look like? I talk about that. And so then come back to square one and say, how can I build my portfolio today so that I will survive the turmoil and prosper under the new rules of the game? That's kind of the book in a nutshell.
Well, Jim, and let me touch a little bit, too, on what you had just mentioned about inflation, because something you said recently in another interview, which was so incredibly sobering to me, was that central bankers in private, off the record, will admit, hey, we're basically making this up as we go along. And I look at that, and I look at what the Federal Reserve is doing now and contrast that with how the Fed responded to the massive inflation of the early 80s and Volcker and raising interest rates. And I think to myself, here we now have a Federal Reserve that's saying, listen, the key to getting this economy going, the key to lowering unemployment is inflation. And in fact, that's the exact opposite strategy of what the Federal Reserve was doing in the 1980s. So I guess the fact that the majority of us have kind of bought into their rhetoric, when in fact we've got the most powerful central bank in the world making things up as they go along, kind of rewriting it as they go. And at the core, really, I realize the problem is multifaceted, but at the core, we have a central bank that has the arrogance to believe that no matter what direction the pendulum swings, they will always have the tools to bring things back into an equilibrium.
Well, that's exactly right, Brian. I mean, to think about Volcker and Reagan and that period that led to very, very strong growth. I mean, in 3 years, from 1983 to 1986, the U.S. economy grew 16% in a 3-year period. The last 3 years, we've grown about less than 2%. So we're getting anemic growth. But what we had then, we had high interest rates and low taxes. Today, we have low interest rates and high taxes. We have the exact opposite of what worked for Volcker and Reagan. So it's no surprise that we're doing very poorly. But your second point, I not only agree with, I would amplify this, which is to say that if you have the wrong model, a model is just a way of understanding how reality works. It's a construct to help you, guide policy. If you have the wrong model, you're going to get the wrong result every single time. And the Fed does have the wrong models. They're not stupid. I mean, I know a lot of these people. They're twice as smart as I am. They've got 170 IQs. They've got PhDs. They're professors at Harvard or Chicago or Berkeley or Yale or wherever the case may be. But the problem is they've just got the wrong toolkit. They're using these what are called dynamic stochastic equilibrium models, which sort of says that the world is normally in an equilibrium, then something perturbs it, it goes out of equilibrium, and what you do is apply policy and push it back into equilibrium and wind it up like a clock, and we all live happily ever after. That is not how the world works. Empirically, it is not how markets behave or how prices behave. In fact, the world is a complex system. The world of financial markets and capital markets is a complex system. For short periods of time, complex systems can resemble equilibrium systems, but when they go wobbly, they shoot off in very unexpected directions, as happened in 2008 when we had a global financial catastrophe that would have closed every major bank in the United States, but for the Fed intervention. And I think it would have been better if we had shut all the banks and, not permanently, but just, nationalize them, wipe out the stockholders, strip the bad assets out, put them in trust for the taxpayers, and then re-IPO these clean banks so that they could actually make some loans. That's not what happened. Instead, the stockholders and the bondholders were propped up. Management stayed in place. Nobody went to jail. The bad loans are still on the books. And we're just like Japan. The United States, you go back to 2008, you'll hear Bernanke saying, we don't want to repeat the mistakes of Japan. Well, the United States has repeated every single mistake, that the Japanese made in the early 90s. They did the same thing. Instead of closing the banks, they propped them up. Instead of holding people accountable, they brushed it under the rug. Instead of writing off the bad assets, they kept them on the books. The Japanese have had 30 years of lousy growth, or actually declining GDP. Is it any surprise that we're getting lousy growth today? We did the same thing. We should expect the same result. So again, these people are not dumb. They're not, evil. It's not a conspiracy to destroy the U.S., although they're doing a pretty good job of it. They're actually very bright people with the wrong models, misguided. They are very arrogant. You're right about that. And they think they know better than the rest of us, and they don't.
Well, and Jim, we are repeating the mistakes of Japan. And, when the central bank first announced quantitative easing, the primary, argument against that strategy from critics of the Fed was that we would ultimately reap the terrible financial pain of inflation, and it would just financially obliterate us. However, you look at how long Japan has been struggling with low GDP. You look at the fact that, okay, granted, the United States government, we know that they sort of hide the real inflation numbers by throwing out that food and energy prices in their calculations, but inflation has yet to really reach the levels that many analysts had predicted previously. The Fed has expanded the money supply. Why are we not yet suffering the inflationary consequences?
Well, we haven't had inflation for two reasons. And you're right, the Fed has printed almost $4 trillion. And a lot of critics have said, well, if you print $4 trillion, you're going to get inflation. But in fact, we have not had very much inflation. So that is correct. Well, there are two reasons for that. Number one, a lot of the inflation was exported to other countries. And this is what the currency wars are all about. In other words, just to explain how that works, let's say I'm China and I want my currency to be cheap because I want to promote my exports. Well, here's the United States printing all this money. If I want my currency to be cheap, I've got to go buy up all those dollars because the dollars were coming to China. They were coming to China through two ways. One is direct foreign investment and portfolio investment. And the other one was through the Chinese trade surplus. So all the dollars that were being printed in the United States, not all of them, but a lot of them, went to China. Now they're in China, so the People's Bank of China said to their exporters, "Hey, if you make dollars, you have to give them to us at a fixed rate," because they wanted to maintain the value of the yuan, which is their currency. They didn't want it to go up. So if we were printing money and that money was going to China and they wanted to buy it up, they had to print their own money to buy up the dollars, and they did. The People's Bank of China has actually printed more money than the U.S. Federal Reserve in the last 5 years to soak up all these dollars. So the inflation was breaking out in China. In other words, if you outsource your monetary policy to the Fed and the Fed prints money, you have to print money to maintain the peg. And so the inflation was showing up around the world. It was showing up in China, in Brazil. It was a big part of the Arab Spring. So that's the first thing that happened is we exported our inflation through the exchange rate mechanism, through the currency wars. That's starting to end because, we've insisted the Chinese actually got worried about inflation and let their currency go up a little bit, although lately it's been going back down again. Again, that's very typical of the currency wars. It goes back and forth. But some of that inflation may begin to come home to roost. But the second thing, and I would say even more important than the first, is that inflation takes two things. The money supply is only half the equation. The other half is what's called velocity, or the turnover of money. You can print all the money you want, but if people don't spend it, if they don't borrow it, if they just leave it sitting there, then you're not going to get any inflation because there's no turnover of the money. So I like to say it's like if you want a ham and cheese sandwich, you need ham and cheese. The money supply is the ham, but the cheese is the velocity, and we're not getting the velocity because people are worried. They're scared. They got burned in 2008. They want to save their money. They don't want to spend it. So the Fed knows how to print money. They do that all day long. But how can they get you to spend your money? That's the hard part. How can they increase velocity, bend the velocity curve, and change the psychology? Well, they have to lie to you. They have to, tell you to look for 2% inflation and actually try to get it up to 3%. They have to pump up the stock market, pump up the housing market, create the so-called wealth effect, which is an illusion, but make you feel that you're richer than you actually are. There's a lot of happy talk around the economy. The Fed's doing everything possible to manipulate people into spending, but so far they haven't taken the bait. So I like to say it's a strange thing when a central bank wants inflation and can't get it, but that's where we are.
Yeah, can you imagine if the Federal Reserve would have been able to conceive of 1% annual inflation back in the 1980s? Well, Jim, whenever I talk about inflation, I talk about the potential of a dollar collapse on this show. I inevitably get a slew of emails arguing that the dollar will not suffer the fate that so many analysts and historians have predicted, because ultimately the rest of the world, yes, even China, has an incentive to protect the greenback and ensure its survival. What's your perspective on that argument? Is China fearful of a dollar collapse? Is that why they're buying all this gold?
Absolutely. Now, here's the thing. China has $4 trillion in reserves, and almost all of that is in paper assets. Some of it, they're buying more hard assets, buying more gold, but they have a lot of it in paper. Of that, about $3 trillion is in U.S. dollar-denominated securities, and over half of that is in U.S. Treasury securities. So they have over $1.5 trillion in U.S. Treasury securities. So at one level, they're the dollar's biggest fan. They definitely want a strong dollar. If you devalue the dollar 10%, that's like a $300 billion wealth transfer from China to the U.S. because their assets are worth less, and our debts their assets are worth less, which means our debts are worth less. So it's really transferring wealth from them to us. There's an old saying in banking, Brian. I'm sure you've heard it, that if I owe you $1 million, I have a problem. But if I owe you $1 billion, you have a problem because you have to collect it from me.
Right.
I can walk away whenever I want. So China's since we owe China, $3 trillion, they have a problem. So at one level, they want a strong dollar, but they understand that we want a weak dollar, and so they're trying to protect themselves against that. They cannot dump the securities they have. They might like to at some level, but The markets are big, but they're not that big, and that would get out of control very quickly. So that they're not going to dump what they have, but what they are doing is acquiring gold. When I say acquiring gold, I'm talking about thousands of tons. Now, bear in mind, all the official gold in the world only adds up to about 35,000 tons. Now, that's not counting private gold, so yeah, there's a lot more in jewelry and watches and engagement rings and all that. But the official gold owned by central banks and finance ministries is about 35,000 tons. China has acquired 3,000 tons approximately in the last 4 years. In other words, 10% of all the official gold in the world, and they're still acquiring more. So why are they doing that? Some people speculate that they want to launch the yuan, that's their money, as a new gold-backed reserve currency. That's nonsense. That's not going to happen for 10 or 15 years. The yuan, it may have a role as a trade currency, but it's nowhere near where it needs to be in terms of a reserve currency, because to be a reserve currency, you have to have things to invest in. You have to have investable assets. That means a government bond market. They don't have a government bond market, and they don't have the infrastructure. They don't have dealers, settlement facilities, repurchase agreements, financing facilities, futures options. You need a lot of things to have a government bond market. They don't have any of it. So the yuan's not going to be a reserve currency, but the gold is a hedge. So if the U.S. maintains a strong dollar, they might not make very much on the gold, but they'll do very well on their paper. But if the U.S. cheapens the dollar, they'll lose badly on the paper, but inflation will take off and they'll make it up on the gold. So what they're really constructing is a balanced or hedge position with gold and paper, where if one gets hurt, the other one makes a lot of money. So my advice to investors is if it's good enough for China, it's good enough for the rest of us. In other words, have some gold, not 100% by any means, not even 50%, but have 10% of your investable assets in gold, then you'll look like China. You'll have a lot of paper assets and some gold. If the paper assets perform well, then good for you. But if they don't, gold is your insurance.
Absolutely. Jim, if I can for a moment, I'd like to get your take on the crisis in Ukraine. My audience obviously is particularly concerned with the impact that an escalation of the crisis could have on gold prices. But additionally, I'd like you to talk about retaliatory economic warfare and what that looks like in a standoff between the U.S. and Russia and the risks posed to the U.S. economy in such an event.
Sure, Brian. For this, we have to go back really to the Cold War, which, was a long period. At the time, it was called the Soviet Union. Not Russia, but Russia was obviously the main power behind the Soviet Union. And when the U.S. and Russia confronted each other during the Cold War, you had the following situation. The United States had enough missiles to basically destroy Russia. Russia had enough missiles to destroy the United States. This was actually a very unstable situation because there was an enormous temptation to shoot first. You thought, gee, if I shot my missiles first, wipe out the other guy, I win. So what this led to was an arms race where both sides tried to acquire more and more missiles to build what was called the second strike capability. And the idea was if the other guy shot first and wiped out your country, you would have enough missiles left over to shoot back and wipe out his country. So this, we actually call this two scorpions in a bottle. And the metaphor is that, if you have two scorpions in a bottle, one stings the other, the victim will die but has just enough strength left to sting back and they both die. So that actually created a more stable situation, even though it was scary with all those missiles. Now, come forward 50 years. Today we have the same situation in financial space. The old nuclear warfighting doctrine was called mutual assured destruction, or MAD. I call the new one mutual assured financial destruction. And what's going on now? Of course, Russia took Crimea by force. And the first thing they did, by the way, was change the currency. If you go to Crimea today and put your card in an ATM machine, Russian rubles will come out. They took their two big banks, Sberbank and Bank of VTB, and converted the local economy to Russian rubles. So that's part of what's going on now. Nobody, left, right, or center, thinks that there should be a military response to this. Nobody wants the 82nd Airborne, dropping into Crimea. NATO's not going to do anything. But the U.S. doesn't want to appear to do nothing. So the U.S. is engaging in economic sanctions, which is a form of financial warfare. And we have a playbook. We've been in a financial war with Iran since 2012. I talk about this in my book. This is all in Chapter 2 of The Death of Money. But here's the difference between Russia and Iran. Unlike Iran, Russia has a much greater capacity to fight back. And so now you're back to this escalation scenario where we do something to them, they do something back at us, and it kind of escalates from there. And where does that end up? Well, at the extreme, Russian hackers could close down the New York Stock Exchange. And people who are skeptical of that, I just point them to August 22nd, 2013, when the NASDAQ was closed for half a day. To this day, we've never had an explanation. No explanation has been offered as to what happened there. And if it was, Syrian or Iranian or Russian hackers, there would be good reasons not to tell anybody because you'd scare investors half to death. But the point is, the Russians are capable of that, and we know it. So, in theory, you don't want to escalate because you'll end up in a very bad place. Based on that, I said, well, the U.S. sanctions will be very tame because, again, they want to avoid this kind of escalation. There's a lot Russia could do. They could freeze U.S. assets in Russia. They could dump U.S. government securities, kind of like what we talked about earlier with Japan, drive our interest rates up, sink our housing market, sink our stock market, all the way up the food chain to closing the New York Stock Exchange. So on that basis, the U.S. shouldn't get that aggressive. But today, they actually did. The United States Treasury issued new sanctions, and included on the list was a guy named Igor Sechin. Now, you can't expect every listener to be a Kremlinologist, but Igor Sechin is actually more powerful than Putin. He was a KGB guy. So was Putin, by the way, but Igor Sechin outranked Putin in the KGB, and he's a behind-the-scenes operator. He's the head of the second largest oil company in Russia, a very powerful business executive, but he's the real kind of power behind the scenes. So we put Sechin on the list. So I expect the Russians to retaliate in the next couple of days. They're not going to stand still for that. They're going to do something, don't know what, but it'll be significant, and then we'll see what the U.S. does. But we're going down a very dangerous path that could lead to some of these extreme outcomes. And remember, you go back to the Cold War, there were two movies that actually portrayed what I'm talking about. One was Fail Safe, the other one was Dr. Strangelove. Both of them involved nuclear warfighting between the U.S. and Russia, but they both involved either an accident or some madman in the chain of command. So things happen by accident. Even if Russia's trying to restrain themselves, do they accidentally launch a cyber attack that gets out of control? So I'd have some gold, I'd have some cash, I'd be extremely wary of what comes next, because I think the Russians, this is like The Godfather. We whacked them, they're going to whack one of our guys next.
Well, I think I'd rather have Peter Sellers in the White House right now, but that's another conversation. Jim Rickards, the latest book, The Death of Money, The Coming Collapse of the International Monetary System. I absolutely encourage my listeners and viewers. In fact, I plead with you to pick up a copy of the book. It is absolutely something that belongs in your library. And Jim, thank you so much for taking time today to be on the program.
Thank you, Brian.